Could this fund outperform with less risk than the S&P 500? All right. So I've been reading this article because this is very interesting to me. So I've been working with my man Craig Israelson, as you know, in his retirement portfolio analyzer spreadsheet you can get. It's freaking fantastic. And there's some negative Nellies that say, well, Craig Israelson's 712 portfolio, because that's where the basis of. That's how I got to know Craig, just reading through Horse's Mouth and various financial planning magazine and stuff. And I said, man, so when I reached out to him, he said, yeah, he'd love to do an interview. And here we are. I'd call Craig a friend of mine. He freaking crushes. Great guy. Crushes. Anyway, the premise how I came to find out Craig was in the aughts, when everything was getting trounced. The one thing that didn't get trounced was his 712 portfolio. And so this is what we're seeing here, the 712 portfolio. But we're not going to talk about this today. We're going to talk about something else I want to share with you. But the point was, when you spread your risk out, I got to close the door. Oh, no, I guess I can't because I got dogs sitting right there. So I'm air conditioning the outside. Great. Al Gore's going to put me in jail, Finney. Oh, boy. So when you're spreading your risk among many different asset classes, it's hard for one of those asset classes to take you out. A la in 2001 and 2, the S&P 500 got smoked. But wasn't the S&P? It was the S&P 500. But it's the growth stock of stuff of the S&P 500. Wellington, you'll notice, did fine. Value stocks did fine. If you look at Windsor, now 2002, they didn't. Come here. But they didn't get destroyed nearly to the extent that the S&P 500 did. And the reason for that is because the S&P 500 was so heavily overweighted in the tech stuff that when tech fell on its back, everything went down with it in the S&P 500 as a whole. But these other stocks did not. Dividend stocks did okay. Well, just bonds did fine. So where I was reading in Financial Planning Magazine and Horse's Mouth, Craig had written about this. Like, look, this 712 portfolio has done fine. It did. It survived the whole odds. Now, over the last 10 to 15 years, it has done poorly relative to the S&P 500. Not poorly as an investment, but relative to the S&P 500, because the S&P 500 has just blown everything out of the way. It's just a fact. And so, and the reason for that is what they used to be called the Nifty 50, what do they call it now? The Magnificent Seven or something like that. So the Magnificent Sevens represent more and more of the proportion of the S&P 500. This reminds me a lot like 1999. I'm not saying these companies, NVIDIA and Amazon, have the nosebleed or PE ratios like we had in 1999. I'm not saying that. I'm not even saying you should get out of the S&P 500. I'm not saying that at all. I'm just doing this video because of interest to me. And so if we go to Craig's 712 portfolio, he's got 8.33% in all these different asset classes. Commodities, real estate, cash. I can't read all that, what that stuff is. But you can see right here, this is 712 portfolio. And if we look at historical performance, we're going to come over here. We're going to see of the 7 major asset classes, you'll see right here, this equal weighted multi-asset portfolio has done 9.33%. Since what was it? Since 1974, 9.33%. Where the let's see, where's the S&P 500? The S&P 500 thing's done better. I can't remember, but you can see right there, 9.33% average since 1974. All right, now it's gonna be tough to mimic that because you got to rebalance and all these different asset classes every year. But it just shows you right there with a standard deviation of 10.52. All right. So actually we can compare that to S&P 500 because we can go 1974 to 2023, 9.33 versus 10.52. So let's see what the S&P 500 did. And we're going to go to the Political Calculations website, which is freaking awesome. Love these gents, these germs. Ladies and germs, we're going to go to 1974, and we had 9.33. And we're going to have you guys just sit there while I thumb through this. My man Paul Fraser said the other day, watching you on the internet is like watching my do a spreadsheet. It's like watching my grandpa figure out the internet. I thought that was pretty funny. 1974, and we're going to go to the end of 2023, right there. Boink. Right. I don't think it has standard deviation here. So we're going to see, 11.11% with full dividends. So if we see Craig Israelson stuff, average 9.33. But the S&P 500 averaged 11.11, and I don't know the standard deviation off the top of my head for the S&P 500, but I can almost guarantee you it's more than the 7 asset class portfolio. Does it have standard deviation here? Yeah, I'll see it. I think it's almost 15% or something like that. Be it as it may. So anyway, so then what happened was there's this Rob Arnott from the Research Affiliates was writing back in the late aughts, early teens about the equal weighted S&P 500 index. And there's a ticker for that. By the way, don't forget to fondle the like button, fondle it and tickle it at the same time. We're fondling and tickling. Tickle, tickle, tickle. Tickle, tickle, tickle. Pretend you're tickling Pablo. Don't forget to do that. And if you haven't subscribed, subscribe. Now, if you don't like my politics, don't subscribe. I don't care. But if you're like, this guy Josh, he's all right. I'll take what I can and I'll leave the rest behind. That's fine. Because I'm going to encourage you. I'm going to tell you where it's at. And all of a sudden you'd be like a Josh zombie. Like, Josh says go. I'm going. Zombie say. Zombie dumb, says the Reverend Horton Heat. Anyway, so back then, Robert Knott had said, look, the equal-weighted S&P 500 actually outperformed the S&P 500 in the odds. And that kind of made sense to me because you're spreading your risk among basically smaller stocks in particular. So you didn't get nearly as crushed in the S&P 500 as you did because you're spreading your risk among. So what an equal-weighted, it's just different, just exact same thing as Craig Israelson. Instead of having the market cap weighted, where the basically top, in this case, top 10% of the S&P 500 stocks are representing like 35% of the entire portfolio, you're saying each stock in the S&P 500 will be 1/500th of the size. So Apple will be 1/500th, so will freaking Joe Smoke Shop. They'll all be 1/500th. And so the problem with that is when we have a massive rally of these top 7 to 8 stocks like we've had in the last 10, 15 years or so, Apple becomes bigger, Amazon becomes bigger, whatnot, and Joe Smoke Shop, because it's still as equal weighted as Apple, is holding the index down, if that makes sense. And this is where the market cap dominates, and we'll just show you right here. So I ran a portfolio visualizer thing. And yeah, it's not portfolio visualizer. It's freaking stupid. This is better than not. But why'd you do that portfolio visualizer, man? And you'll see right here, going back to 2010. The S&P 500, this is in blue, as $10,000 in the S&P 500 is worth $62,000 as of 2024, where it's only worth $50,000 in the equal weighted, which is RSP. Did I already say that? I can't remember if I did. RSP, and the S&P 500 is VOO. So Romeo, Sierra, Papa, all right, versus VOO, Victor, Oscar, Oscar. All right, so but the question is, that's great and all, but what did it do before that? And we're going to go to this article right here. I got the hiccups. Oh my goodness, hold on a second. Oh boy, how did I get the hiccups? I'm going to show you something. I'm not sure what this is representing actually. This, I don't get it. So the index level started at, I guess, 0 in 1970, and the equal weighted ones at 500 with the S&P 500 is 250 or 270. That's not a very confusing chart. I want to show you something different. Oh, right here. Right here. U.S. equity market concentration reached the highest in half a century. All right, so that, in of itself, you're like, oh my goodness, let's keep going. That's not what I'm looking for here. I'll show you what I'm talking about. Momentum is also historically extended. This is all for the market cap. This is the S&P 500. You can see when the high right here, and then we got whoop. When it got high right here, I don't know. And we got high right here in 1979. Now remember, 1982 was the bottom. All right, so 1982 is the bottom. So we got smoked from 79 to 82 is when you really should. If you were buying stocks in 82, you freaking made money, man. That's just I'm not saying you only had to make money in 82. I'm just saying that's usually the beginning of the great reawakening of the equity markets. So in of itself, this tells us, okay, this is high. It was equal high as it was in 1999. The nosebleeds in 1999 aren't the same as right now. I'm just telling you right now. The PE ratios are much, much lower than they were here for right now. So I'm not in the same category. I'm just not. I want to show you something else right here. So this is interesting. So over the last 10 years, the S&P 500 has beaten the equal weight by 200 basis points a year. And that's real money. I just showed you. Over the last 15 years, it's pretty even Steven. Over the last 20 years, though. Now remember, the last 20 years does not include the first 5 years of this century, which the S&P 500 got smoked. Over the last 20 years, the equal weighted index beat the S&P 500 by 5 basis points, not much, but a hell of a lot risk. And again, I don't know the exact standard deviation of the equal weighted index, and it might be higher. I don't know. But look at this, man. I mean, the S&P 500. I just want to show you this. This right here. Whoops, that's a big draw. Did that happen in the equal weighted index in 2000, 2001, and 2? I bet it did not, because the equal weighted index doesn't have as much in one sector. And I'm going to show you here in just a second. And if you look at the full period from 2003 to 2024, the equal weighted index beat the S&P 500 by 40 basis points. Again, not a huge percentage, don't get me wrong, but it did take some of the downside risk off the table. Here we got the equal weighted index versus the S&P 500. S&P 500, 32% of the S&P 500, about a third, is in IT. Only 13.4 is in the equal weighted index. 8.1 is in industrials, only twice that in the equal weighted index. Healthcare, roughly the same. There's another one in here, right here. Real estate is 3 times that in the equal weighted index as it is in the S&P 500. Utilities, 3 times that roughly. Materials, about 2.5 times. But again, you can see right here the difference right here. Communication services, only 4% of the equal weighted index, whereas 9.3, all right, and the S&P 500. The equal performing and equal weighted index wins over history. I don't know if it's going to happen in the future, as they had access to more smaller size companies, all right? And so you can see right here, the largest weight of the S&P 500, 7% of the category. The top 100 companies in the S&P 500, 69% of the S&P 500 is the top 100. That means the next 400, 30% or the next 400, if that makes sense. And the bottom is basically just the bottom feeders hardly have any weighting in the S&P 500, where they're 2% of the equal weighted index. Isn't that interesting? And the small companies, if we know our history, which we do from 1976 and 1983, the small companies so overwhelm the large companies, that's what makes a small cap premium. I don't think that's going to continue. I don't know. But I will tell you, what we also do know is that when things have a massive momentum, and when a momentum shifts, the things that built up the momentum can shift very quickly to the downside. Momentum and trends are a big deal in investing, and the S&P 500 is based on momentum and trends. It's just fact. And so now that we have this massive momentum of IT, a third of the S&P 500 is in IT alone. If that changes, I don't know if it's gonna, the S&P 500 will be more volatile going down. And because the equal weighted is more diverse, it just is. And I would think intuitively it'd have less downside risk. I can't say you should do this. I don't know anything about your portfolio. This is why I have VTI, by the way, because VTI is 30% small and mid-sized companies, just FYI. So of VTI, 70% is the S&P 500, but the other 30% is small and mid-sized companies. So I'm not changing anything because I don't have S&P 500. I got VTI. Because even though this right here, the top 100 companies represent 70% of the S&P 500, it only represents 0.7 times 0.7. It only represents half of my portfolio. The reason being because I have 70% of my VTI is the S&P 500. 70% of the S&P 500 is representing the top 100 companies. So only it takes 0.7 times 0.7, 0.49% of my portfolio is the top 100 domestic companies, which means 51% is the rest, small, mid, and everything else. And that's why you'd want VTI over VOO, in my humble opinion. And if you want to diversify more, you go to equal weighted thing if you want to. And again, I don't know what the hell's going to happen. You don't know, but I just find it very, very interesting, especially given that we've had such a run for 10 to 15 years of the S&P 500 outperforming. All things revert back to mean. And I don't know if the mean is equal weighted to do better. I don't know. Or if the mean is that the S&P 500 continues to do better. We don't know what the mean is. We don't. Because you can look at any time frame in history, so that's the mean. And I said, well, I look at a different time frame. This is the mean. Oh, yeah, but my mean is better than your mean, so no one knows. Yeah, it's just something to think about for sure. It'd definitely be looking at VTI, if nothing else. And again, I can't tell you what to do. I don't know you. I don't know what your circumstances are. But VTI is absolutely more diversified than VO, without question. And it's still heavily VO, don't get me wrong. But something to think about. All right, love your thoughts. God bless. We'll see you.